There you go.
Good morning. This is Stan Yabroff. I'm a product specialist at CQG, and I've been the coordinator of the CME Group University Trading Challenge on CQG side. I want to welcome all the students that are logging in as a guest of the CME and CQG and White Wave Trading Strategies. I'm going to introduce and then turn over the meeting to Judd Hirschberg, who will give you a little bit of background about himself and the process in which he follows in analyzing the markets. And also welcome Ira Harris. Both these gentlemen have been trading for more than 40 years and have been actively involved with the CME Group through those years. So I'm going to turn the meeting over to Judd, and he will give you an overview. And I want to thank everybody at White Wave Trading and everybody in the trading room for allowing us to come in and listen to their process and listen to live traders looking at the markets. Thank you, and it's all yours, Judd.
Thanks, Stan. Just to give you welcome, everybody. It's a pleasure to have everybody come in and people from all over the world. The room is interesting in the fact that we have a lot of different styles of traders. We have registered investment advisors. We have former hedge fund guys. We have people that are day trading the indices. We have swing traders. We have long-term traders. Some people only trade equities. They trade ETFs. A lot of people only trade the indices. You know, Ira and I've been around a long time. Ira's probably the finest global macro analyst in the world. And what we try to do is take the story, match it with the technicals, and a lot of the technicals and indices and indicators that we like to follow, you can only get on CQG. For example, yesterday morning, if you were just following S&P bond spread on the 240 minute, you saw that the first thing in the morning, it put an ORH bottoming pattern in, and that just told you right then and there it was risk on, and don't be short the rest of the day, and you're just trading capital flows. So White Wave, what I like to do is match up big cap tech. I like to take, the oil and then break down the oil names and see what's following the underlying commodities. I like to look at the NASDAQ and break down the bigger macro names in the NASDAQ and match it up. So what we try to do, the more things that match up, whether it's the currencies, the bonds, the equities, the big names, the more accurate our indicators are, and the better the turns are that we follow. I started trading on blackboards, currencies on blackboards, and came down to the Merck in 1974, started trading in 1975. Ira came down just after me. So, we've seen the movie and been around. Ira, would you like to say a few things about what we do in here?
Well, we always stress that what your strengths are, that's what you have to utilize. You always have to exploit what your strengths are. So some people, like Judd, is a much better, as the phrase we use in the market, is a technical analysis. His ability to read chart patterns is far beyond mine. What I bring is my deep knowledge of currency and bond markets globally. I was actually learned that back in the 70s when I was in school, in graduate school, and I've been able to apply it to understand the context and nuance of the geopolitical world and therefore markets. And I've been able to exploit my advantage or my deep knowledge base over 44 years of trading. I learn something new each and every day, and that's not a trite comment. That's a very serious comment, because this world is a dynamic world. If you treat it in any static measure at all, you will have a very short run, or you better have a very big trust fund in order to supplant it, or have great access to what we call OPM, other people's money. Because this market, if you will allow it, and when I say this market, I mean the global macro market that I exist in, is so dynamic. You cannot get and go, well, this is the ultimate. No, it's not. You are. I learn each and every day. Really, I find something new each and every day. It teaches me, and most of the time I learn from my losses, because I was so convinced that this trade was the right trade. How did it not work? It was based on my best fundamental analysis combined, because I do utilize technicals. I mean, Judd provides me with technical analysis, and I find others, and it's not like I can't read a chart. It's just not my strength. So I cannot get lost in doing that. I have so much, I work at this 12 to 14 hours a day reading and searching out and talking to people. I have after all these years, a lot of contacts who just to discuss things with, because what am I missing here? How do I not seeing this? Yeah, there's some days that are boring. There's nothing to do. And those are the days you have to walk away and go, I'm going to wait. It's not my kind of market. But even that provides you with the opportunity to learn more and more. So if you open your eyes and you're receptive, you will learn many things, and you will, every day you'll learn something. Wow, I thought I knew that, but I guess I didn't. So I always think of this in a dynamic fashion, not a static fashion. Do not get lost in any one comment. And it's just, everybody's got all these cute phrases and everything. Search beyond that. That is, and challenge yourself with everything. You have to challenge. This is as much a self-analysis every day, and how you challenge yourself and deal with yourself. But don't get down. Always use every setback as a learning experience. It really is very important in that regard.
On that, to follow up with what Ira just said, you try not to get lost in the minutia, and try not to get sold on these short time frame, get rich quick analysis stuff. We're global macro traders. We're trying to find, big level support and resistance areas, not the one tick, but the level. So we can buy before we sell, or sell before we buy with known risk. And the whole idea of what we do is risk management, and waiting for the board to set up across the equities, the names, the currencies, the bonds, commodities, a lot of times, especially in the last 6 to 9 months. And it all gets down to trade location. Where can you trade and know where you're wrong? Now, this morning, obviously my speaker was turned off, but Brian was asking about the oil. So he wanted to do an oil trade against $76 early this morning. And that was the exact thing to do. And we'll go back to what he was looking at. He was looking at a 25 by 3 and a 50 by 3 point and figure. And he could tell by looking even at the hourlies that he could buy first with risking just below $76 to see if he could catch it for $1 to $1.50. And that turned out to be a good trade. Johan, all the information's on my website. So the S&Ps have just moved. The average big standard deviation move in the S&Ps is close to 100 points at this right now. It takes a 96-point move in the S&Ps to turn this from up to down to up to down. Those are each 96-point moves. 1, 2, 3, 4, and we just had another 5th. This one is extended almost to 140 points. Over 100 points, if you chase that direction, it can go 20 points, another 40 points. But what you don't want to do, oh, sorry, Waylon. Thank you. Am I on the right one now? Okay, is here. There's 100 points, 100 points, 100 points, 100 points. Now we're into almost 140 points coming up. Now you can see where on the 25/3, it's getting into cloud resistance. The 480 Heiken Ashen is already in a cloud resistance. You can see the, I overlay clouds on the point and figures just to get some idea of where the built-in fibs are. And that's coming up into 04 again. So you can see that green line, that's basically a balance line, or almost basically a 50% area. So it's 44.0475. So the style of trading we have in this room is that nobody's going to buy this looking for 10 points. And the guys in this room usually like to day trade or swing trade for 40 or 50 points in the S&Ps if they're going to do a trade. So they might not do anything here. Yeah, thanks, Leaf. And you can go to my glossary and the website, and you can look at my, so you can understand my my verbiage. Basically, it's shorthand from training proprietary traders that traded the S&Ps and NASDAQ for me in in the late 90s, early 2000s, while the pits were still rolling. So, we talk about what the relationship is on one asset class to another in this room. So right now, I'm looking at this is the 30-year yield chart. And it's taken a couple of weeks for the yield to come back to its momentum line, which was this morning. And now it's breaking back above its 200-day. So as the yield starts squeezing up again, that's going to hit the gold, the silver, and it should be short-term negative on big cap tech, because big cap tech likes low interest rates. So we spend a lot of time talking about these relationships and looking at different types of charts to confirm, what we do in this room. For example, this morning when Brian asked me about the oil, the first thing I threw up was an oil in yuan. I wanted to see if the oil based in yuan terms was doing the exact same swing as the oil in dollar terms. And then I looked at, wait a second, there it is. Oil in ruble, which, this is a topping pattern, an ORL topping pattern. And if a market finds a low, the most natural spot that it wants to come back to is to retest the breakdown level, the previous breakdown level. That's what you're seeing right there. 77.47 was that same number in the crude. That just happens to be a number on my sheet that it's now beginning to pick up. But you can see that that's resistance, and you do not want to be long oil going into that level. All that is a retest of the breakdown level. So that's an exit zone the first time up. All right, so let's just go back and see what the day is going to bring here. Amazon this morning, was up into its 200-day early in the morning, and now is since backed off. That green ball there is a bullish pattern. It's followed through, but it's already beginning to fade. So I have a number of different things up on my board here. This is the SPZ 21, guys. That's point and figure charts, Johan, and only CQG has got the best point and figures in the world. Where am I at? Sorry. Thanks, Sean. I can't keep me on that because I can't tell what screen I'm on right now. I don't know why, but it's not showing it highlighted. Am I on the S&Ps now? Okay. All right. These are point and figure charts, okay? So you can look that up. Point and figure charts, all they show you is price. I don't use market profile, which throws in volume. I don't care about volume. Risk is measured by price, not volume. And I only look at price. It's the only thing that matters to me is price, because that's how we measure risk and where we can buy or sell and know where we're wrong. It's all I'm interested in. So this is the US session in S&Ps, and this is the US session in NASDAQ. So the beauty of CQG is it allows you to break out, and here you can see CLX. This is the US session. This is the overnight session. See, it's nice to see what the capital flow is during the US session versus the Globex session overnight. It tells you a lot about the market and how it's going to trade. And CQG allows you to see that. These other platforms don't. You have to manipulate them to get that. The other thing is you can get S&P bond spreads. You can get, I look at DAX Bund. I can look at US session S&P bonds, and that'll give me an extra 20 years of data versus the minis, which everybody else is going to try to tell you that's all you need, and it's not. So the two things about CQG is capability. It's point and figures. It's the spread bars that let you show relationships, capital flows in and out of different currencies and commodities. It shows you how money is moving. And you can't get that with any other platform. You'll get a line chart, and you can't do any credible work on a line chart. So you can see that the shortest time frame chart I've got up is an hourly chart. And it goes to 240, 480 daily, and these longer term point and figures. Anytime I do any type of research, I'll start out with a daily, I'll go out to a yearly, and I'll take a look at it. Johan, all that's in the website. Go to whitewavetradingstrategies.com. Everything's in there. You want to, if you guys would like trials of the service, or you want to get access to, my stuff at night, more than happy to send it to you. Well, there you go. You guys are all welcome to do that.
Johan, I did that and it's well worth it. So I just wanted to throw that out there.
All right, so let's see how this opens up and what's happening here. I think we've already seen an interim high. Now it's how much we come back. So right now we're looking at the S&Ps 43.5. So 66 down to a half is going to be the hold level. So if we start rolling back below 43.5, then I think you've seen an interim high again. And, it's all about tomorrow's employment numbers. And Ira, you can speak to that later on, what your thoughts on what everybody's looking at.
Yeah, in a few minutes.
Okay. And the one thing about this room with Ira and everybody else is we bounce around a lot of ideas and we try to take them apart, and nobody's right or wrong. We just try to poke holes in it. So we try to have a civil discourse on what we think is happening. Is whether, Ira had us, 6 months before everybody was talking about the commodity trades, he was buying Freeport, Southern Copper, and all these other names. By the time everybody else got onto the trade, they had already quadrupled some of those names. So we try to look ahead, and then we look at different names and try to put the board together. All right, let's just see what this is going to do. Yeah, they're already. Just see what the algos want to do here for a couple of minutes. People have come back to some of these credit card names, some of the financials. They're buying the drillers. Peter was on the defense names. Those are up.
I just want to say, Judd, to the group that all of these things that Judd is looking for is available on the integrated client that we gave to each team. Not all these things are available on the mobile devices, at least not yet.
Yeah, so you're not going to see this S&P bond spread on a mobile device. You're going to see them on your desktop on integrated client. Integrated client's the only place you're going to see this stuff. And in a little bit, I'm going to go back and show you why I use integrated client and why it's important to use integrated client. All right, Microsoft is at resistance right now. We'll see if that can, push through. but that's going to be one of the names that's going to do it. Amazon, this is a tough thing to chase here. You're going to look at another $20. And that alone will take you up, that'll take the S&Ps probably up to 04 in a resistance. Semis, transports are above the transports had a really big day yesterday and it followed through. Yeah, Bungee's kind of stalling out up here, Ira.
Yeah, but it's,
It's still hanging in there.
uh,
All it's done is come back and fill that gap, so it's still hanging.
yeah, I know. I'm watching it closely, but it's done it without the grains really moving up, except of course, the one and only all-time highs in the oats,
The oats. Gosh.
$6 a bushel. Kind of funny. Doesn't get a lot of discussion. Let's see that gap. Come on, buddy. Oh, we're like to see it get above that settlement. So we'd like to see it close above 84.70. That would be good.
Yeah, here are the oats. They're just still going. And a good point to all you guys too is that when you're using commodities, and if you're trading commodities, it's not like stocks. You have to look at the right charts. You're either looking at a daily continuation or most of the stuff, you're looking at an active daily. If you're looking at, a comma D chart, like a daily chart, you're looking at the wrong chart. Unless you're looking at a specific month in the cattle. You will not be trading the right time frame or the right contract or the right chart pattern for that matter. So there are a lot of nuances that if you're trading commodities, only CQG gives you that edge. You cannot get that using all these other systems. Okay, so there's the 50% wiggle right there. They're buying chips, Texas Instruments, Intel. A lot of the stuff I just do not want to chase here. Google's up in a resistance. It's Builder's First Source. You've been looking at this for a few days. And I've really liked this name. All right, now you have to wait for these names to play out. Palantir doesn't act very well. Palo Alto Networks and, 5 networks. Some of these cybersecurity names are still doing pretty well. General Dynamics looks good. Northrop is still going. Lockheed Martin's up at its first resistance at its 50-day. Yeah, Frank. At its 200-day. Okay, so with the bonds soft, the insurers, the regional banks, Goldman's firm, JP Morgan, Square, PayPal. In turn, that'll be positive, the Russell. BHP, Vale. Vale put in a bottoming pattern yesterday. Matching a risk on board. Freeport's. I don't know. That's a dog. I like the fact that Southern held its 400-day moving average and popped again.
All right, what do you need from me, Judd, before I disappear from it?
Okay. Do you have any thoughts on tomorrow's?
We seem to be coasting this number. They've massaged it to, it looks about 430,000 to the plus side. The consensus is really for no change in the rate. Of course, we're going to go back to average hourly earnings. We'll see how much that rises with all these incentives and pay raises that are taking place. Some people are looking for almost 0.7% increase in average hourly earnings, which will be big, which will push the bonds down on the initial headline if it's that big. I would say that 0.4 won't move the needle, but 0.7 would certainly move the needle fairly dramatically. But then we'll have to watch the curves, because the 5-year will become, I think, critical, because the 5-year is became a safety play for people who were moving out of T-bills because of fear of the, that was, it's kind of funny that people were most fearful about hold on one second. They were most fearful with the government deficit not being raised, that the government would be defaulting on their payments of T-bills. And of course, that's short-term instruments, okay? Short-term instruments become the biggest part of the discussion. So people went to, the longer stuff was not going to be affected because you had coupons, and coupons will get clipped, and there's much bigger windows of being paid out. So people left T-bill, which is why T-bill overnight in 1 week and 1 month T-bill went up by about 10 to 15 basis points at one time, and then they came crashing down yesterday on the news. They were actually a better indicator of what was going on in Congress than the stock market. Stock market took a little too late, but I think that the 5-year will be the place. That's where I'm going to be looking at tomorrow to, if this data comes out better, meaning, and I think that really takes into the importance of the average hourly earnings. So, and this number has, meaning so if you saw a large non-farm payroll, okay, because I'm going back to Jerome Powell's press conference, what is it, a week ago, 2 weeks ago, 2 weeks ago. So he said that the Fed may be ready to begin, to start tapering if the employment September's numbers were very robust. I'm paraphrasing, but that was the general meaning of his comment. So if you were to get a much bigger number, let's say 700,000, 800,000 in non-farm payrolls, you would see a pretty good sell-off in the interest rates, because that headline, before anybody else read what was involved in the headline, will generate selling of the interest rate futures. Now, where they stop, you better be prepared to get your technicals in order to look at what the key levels are. But that's only because of what Powell's statement was. Now, since Powell's statement, of course, the Fed's in a whole different situation, right? We've had 2 Fed presidents resign, probably a third coming, Clarida. So there's some very serious issues. Now, David Zervos, who I have a lot of respect for from Jefferies, he's a pretty good Fed watcher, but I disagreed with him on this piece. He thinks that if Powell is sure that he's going to go, and some of his cohorts at the Fed, they might become a little bit more hawkish, because they'll want to, and they won't be as concerned, because we know that Powell at the Jackson Hole conference, I said how dovish he became, and he did, and he definitely, and I said, that's when I took the bet off the table, because it was almost like a campaign speech with his dovishness. So I disagree with Zervos, but he did put it out there, and a lot of people are thinking in that regard. I don't think that Jerome Powell gets, I didn't think so before, but I don't know whether to say it's fear or respect. I go back and forth with Lizzie Warren, because when it comes to Wall Street stuff, as this room knows, because I talk about it all the time, when it comes to Wall Street stuff, Lizzie Warren is nobody to, I think she's probably the smartest person sitting in the Senate on understanding the way Wall Street works and the financial system works. And she has really taken them on. Now some people think, and it might be right, that Biden's going to use this as a bargaining chip. But I don't see that Lizzie Warren is up for any kind of bargaining, meaning he'll use Powell, if he wants Powell, he'll compromise on some other things. But there's no way that he can really get into Powell's camp. Because don't forget, Powell was appointed by Trump. Certainly the left and even the center left of the Democratic Party would like for him to be gone. Would like for him, there's a lot of ways for him to get rid of Powell. And especially with what went on with that trading at the Fed and everything with it, it's time for him to go. First of all, he's not, I don't know why everybody thinks he's so great. Let's go back, again to 2018. If you were long bonds and equities with the Powell mistake, and yes, he pivoted, and that's always a sign of an intelligent person who realized that they're wrong. It took him a while, but the whole policy was flawed to begin with. So I don't know. Wall Street loves Powell because Powell has given them everything that they want. If you are lazy on Wall Street, he's the greatest ever, because anytime there's been a wiggle or waggle, they come out and lower for longer, which stabilize markets. So they've been very happy with them, and they don't want that change. And they're worried about the regulatory basis, by the way, because as Lizzie Warren says, Powell's a dangerous man, not because of what went on inside the trading at the Fed. It's that he's rolled back some of the regulations. And he actually fought with Congress on, during the COVID, the regulators suspended the supplementary leverage ratio, which caused banks to hold more in reserve in an effort to support the government securities market, which needed supporting. So they rolled that back. The rollback expired March 31st. There were many, including some people feel Powell, that were lobbying for that regulation to continue to be frozen and not put to use. But Congress repealed and said, no, we're putting it back in. So the leverage ratio, and the Fed was a little bit worried about that, although it really hasn't had much of an effect, although you can argue about the reverse repo market. So I'm giving you because there's a lot of politics involved here. This number, if it gets up into that 800,000, I think it'll be a pretty heavy sell-off, and that'll sell off all the other asset classes, as we know, right? I'm sure the equities will be the first to stabilize because they've liked what they've heard this week politically. The metals will get hit hard. Where they stop, again, you have to do your support levels, because the surprise won't be on. If it's a soft number, I think the market action will be very muted because they're already there. It's Powell's statement, and you can go listen to it on YouTube from the press conference when he talks about, well, they're pretty, and it was the most hawkish thing that he had said, that they're pretty close to seeing some of the employment levels, which really threw me. And if you remember, the market sold off pretty hard during that press conference. The gold, the equities, the dollar rallied. So you've seen this before. So if you actually get the reality of a very strong jobs number, meaning jobs created, I think the market would engage in that across a litany of assets. So if you think that that'll just be a headline mover, then you have to have your support levels in place, especially I think in the currencies and in the metals, because I'm not in the currency bull camp, in the dollar bull. I mean, I'm not a dollar bull, as I keep saying. I think that Powell playing with this tapering and forcing a rally in the dollar, or causing, not forcing, but causing, would be terrible for the global financial and economic system. I think the system does not need a dollar rally, and they better be well aware of it. Janet Yellen is very aware of it. Right now, she's mouthing about other things, but that a dollar rally would be very detrimental to the global economy. So it'll take I probably 700 to 800,000 to really affect some movement of that nature, and then we'll get some good tests. So I hope
So
that
the reason I asked Ira about this to begin with is because typically on unemployment, you get extremes for the month in the 30-year bonds and in the metals. And they give you an area to trade against either way, long or short. And the same thing not so much in the currencies right now, but definitely in the metals. So it's just something to really be aware of.
does it ask questions, because I'm giving you a lot, and especially you students who haven't heard this, but I'm giving you a lot to think about. But you must remember that these boards are driven by algorithms that are programmed to read headlines. So you get dramatic moves. And that's what the key word. Now, I'm an old man. I'm 68 years old. You can say I'm young at heart, but I'm an old man. And I've learned to be patient, where I used to try to trade very aggressively and to take advantage of each and it. It's not the way I operate, because I've realized over these last, let's say 17, 18 years, that these algorithms are so powerful, because that's really how long they've been with us. They just get better and better and better and better and better. So let them drive markets to prices that you can use to your advantage, rather than getting caught in the middle of them. And I think we've done very well with that by being patient, by the way. I know I have. It's changed my whole trading, whether you want to, but I think, the times that I've been in this room and the things we've talked about, especially on Fed meetings and unemployment days, because those seems to be, of course, the most important, have given us great opportunities. And we were using the market for our benefit rather than benefiting others in the market. I think that's the best way to put it. So,
and I think it's really important that, you have all these services in the world that are teaching you to trade like a computer. You can't win that game. And if you miss something, it's okay to miss something. It's really okay to miss something, because you're always going to get another chance at it. You just got to be patient and wait. You'll get another shot. All right. So the other thing I wanted to point out this morning before you go, Ira, I don't know if you were looking at this. I was looking at the long-term SPU bonds, which are going to be, this is going to be big on this tomorrow, because we're back up at that 28 level in SPU bonds again, with the S&Ps, being 150 points off their all-time high. So this is why I use CQG, guys, and this is it in a nutshell right here. Thank you for S&P US. Okay, this is it. This is the PIT S&P, started in 1982, and this is the 30-year bond, which started trading in 1976, I think, or 77. So this relationship spread, these spread bars are important because they really tell you, and they really illuminate how a market's moving from A to B. Okay. Now here I have 40 years worth of data on this chart, on a mini chart, which everybody else is going to try to sell you. This is the only data you need, and you only need 10 years of data. If anybody tells you that, run from them immediately as fast as you can. It's not enough data to see how a market's moving from A to B and understand what is really going on in the world. You cannot see it in a 5-minute chart. You must be looking at a longer time frame charts to see how things are responding and moving. The numbers, the big numbers are usually pretty easy to pick out. It's spending the time to understand how things are moving from A to B. This high matched a target from 2017 when the markets took off. This went up into a quarterly target that I had. Was, where was it? It was 29. The market, the S&Ps were trading at 2,500, and that target was, I think, what, 29.65, guys? It went up to 44 and broke 500 points. And then the spread came up, made a lower low, and we broke 1,000 points. These are the types of little signals that you can get off of CQG you won't see anywhere else. You can't see this on a Bloomberg. You can't see this off of other charting packages. And it's important stuff. It gives you a big edge. And it certainly has been great for the members in this room. So if, you know, I'm going to go back to this other screen for a bit. But if you guys have questions, you should either type them in or ask them. And you can type in a question and I'll answer it, or Stan will answer it. And if you have trouble articulating it, you can always unmute yourself and ask. That's how you learn, asking questions. You know, I've got a specific methodology, and it usually takes, Ezra, how long did it take you to pick up on it? You know, it takes a while.
It takes about 3 months. I think it's about how much effort you put into it, but it took me about a quarter. It really took me 2 quarters because you got to see everything across the large time frames and how they really matter, right? So I would say it took a few months to understand and then a couple of quarters to really be able to apply it on my own. But maybe I'm just a slow learner. I don't know.
No, you're
Well,
not.
Ezra,
You're a fast
it took
learner.
me a year.
What, Robert? And you
So
have to
you-
understand
you are
there's a lot, yeah, excuse me, there's a lot of different types of people in here. Now, Robert is going to speak in a second. He's an executive at a major corporation. There are a lot of people that can't spend all day in front of the screen. So they use this methodology to get into longer time frame trades. Go ahead, sorry.
Oh, sorry, Judd. You have a session.
No, go
other
ahead.
session.
No,
No, I just wanted to say, Ezra, don't feel bad. It took me 4 quarters to see entire mechanism working. And sometimes they behave slightly different. You know, what Judd sometimes refers to as wiggles. You have to understand what's wiggle, what's move, what's noise. Put it in a perspective, compare it to the last quarter, to 2 quarters ago, and eventually it crystallized for me after 3-4 quarters. So you're definitely really good if you could handle it already after 2 quarters. That's all I wanted to say. Thanks.
Judge, you need me for anything else? Because
no, thanks, Ira.
I mean, I hope I didn't confuse them with the way I look at the unemployment. But again, that comes with a lot of work already done this week to look at that and to be, and again, that's the preparation because I have to know what the market's mind is thinking to get the best example. And especially in these algorithms, you get a number up that high, you will. Now, some people think that this number might come in negative job growth because of certain seasonalities, but I don't know. I would have nothing to do with that concept. All right, so
Okay.
I hope I helped you a little bit. If they have any questions, just put them in. I'll leave. I'm going to turn my mic off and I'll answer them on the.
Well, Victoria, I've been doing this 46 years, and there's a few of us had the fortune of having some really good teachers along the way. And a guy that did some really exceptional technical work, and one of the reasons that CQG is the best FX data in the world is largely because of this guy.
Yeah, that's correct.
And he taught us an awful lot, and they're little things in how you put the world together, and it takes a while to see it. It's just not black and white all the time. Sometimes there's, as Ira likes to say, there's nuance to it. And so what's leading and what, a lot of times it's what you don't want to do that either keeps you in the game or keeps you from losing a fortune. And so, I took bits and pieces from everybody that I've learned from over the years and what works. And I had to, Ira was always a thinker. It took me a long time to hear the macro side of it, the fundamental side of it, and put it together with the short-term technical side of it. A lot of times when I hear Ira talk, he's a deep thinker, but for me, what I have to, for my mindset, I just have to know whether I'm looking to buy before I sell or sell before I buy. I kind of distill it to that. Ira is a few steps beyond pretty much everybody, and the fact that he can take that specific macro information and distill it into a trade, whether it's in the yield curves or something else. Oh, for me, it's always technical, and same with Ira and Angel, because it's, the technicals are how you manage your risk. Okay. You can be right. If you're wrong the day of the direction of the market, you're wrong, no matter what the fundamentals tell you. And somebody always knows more than you do. So, I come at it from the spot that I want to know where I'm wrong, so I can buy before I sell or sell before I buy, and test out a thesis. But I'm more interested in capital flow and time frame trading than I am anything else right now.
Hey, Judd, I'm leaving now, so I'm shutting it off. But one of the great nuances that we were able to uncover in this market and make good opportunities was Senor Putin, right?
Oh yeah.
This room is not surprised by anything that's going to come out of Russia, right? Yeah, I think this ruble is going to, he's got with them at 6.75 interest rates on overnight money, the lowest deficit of any significant country in the world. And now, yeah, it was so nice of him yesterday to come out and offer to pump in some more natural gas.
Yeah. Hey, we're not fixing the market. We won't freeze you out this winter.
Yeah, we'll help you out.
So, and this is something that, Ira's been talking about since, I don't know what, 2-3 years now.
Yeah, we've been involved in that.
RSX.
That this was coming. This is hell. I guarantee you, Gerhard Schroeder is going to get a bigger check this year than Robert Kaplan. Oh, wait, did I say that? I'm sorry. All right, that's part of it. All right, outside, because I'm going to go to breakfast.
Okay.
I'll come back. Are they in here all day?
Oh yeah, they can come in for the next few weeks as long as they want.
Okay, all right.
Okay.
I'll probably come back late. Let me go get waffle and some coffee.
All right. Thanks. Yeah, Max, Those are Elliott wave things. I mean, I don't really look at them. You know, I can take them off, I can put them on. If you go to my website, you'll see what indicators I use. They're on there. They're all explained, which moving averages and why I like the cloud. So, you know, this is that line is a 400 average. That's a 200 average. So all you have to do is basically, hold on. You know, the 200 month is down here in the S&Ps. You can see it. This is a 14-month average right there, a 14-week average. This is a moving average of the oscillator. So Stan programmed this in so you can see where it actually crosses versus having it down here in the bottom of a screen where you can't see where the oscillator cross is.
That's a MACD cross.
Yeah, MACD, sorry. You can't see it when it's down here. But you can see it the way Stan programmed it on the screen. And you can see that 44, 43, 73 is major league stuff. And it's also the top of the daily cloud. So the first time up, that's macro resistance. And guess what? What else is up there? The 50-day moving average. So anything up in here is going to be too far the first time up.
For those that are using the integrated client, there'll be a button on the left-hand toolbar that says MAX, and that will default to 21, 50, 200 bar moving averages automatically. So that would replicate the major ones. There's also, you can add a button that says MA, and if you wanted to add a different moving average or change this, you can. So, but that's the default. So that's always there on everybody's system.
So if you want to, you just right click on the chart, it says moving average, you can put it in, you can add it, and then change the parameters on it.
That's if you want ones other than the ones that are on Max already.
Yeah.
And if you look at the help menus, you could actually customize one yourself and put as many moving averages in as you want, which is what we did for Judd. We made it one button for all the moving averages he looks at. And when we said 400, we just added another line. And it was pretty, that's all customizable in CQG.
All right. So Duarte, what are you asking here? Oh, they can increase it. They're just, you know, they control that market. Now let's just look at the nat gas yesterday. I mean, that was all headline driven. You had no RL day. They tried to bounce it last night right up into that momentum line and took it right back into that MACD, and it's holding it for now into these averages. You know, it's really not so much about what it, you know, it's about how this thing holds. You had a breakdown.
Can I clarify for a second?
Yeah, go ahead.
The ORH, what he's using is what we call an outside day, which means it made a higher high, a lower low, and in this case, closed below the low of the previous day. That's what gets those little half circles, or the circles that are half filled in. Okay.
Okay, so what I call this area is the scene of the crime. Okay, these areas are levels that the algos try to push the market to. So when yesterday morning, when we started coming back down, this is where the algos are going to go stop hunting under the previous day's lows. on these ORL, or if it happens to be an ORH, it's the same thing. That's where they go stop hunting. And then that becomes the point of control. So it's good above, bad below. It's as simple as that. And if you go into the glossary, you'll also see when not to take signals off an ORL or an ORH. Because there are specific signals you can get away with taking, and a lot of them you just want to leave alone. So, some of the things you guys should be doing is, trying to read the FT, read Bloomberg. You get an alternative view from the South China Morning Post. Try to stay off CNBC, because what they've got to say there is old news, sometimes weeks old, months old, and they're trying to sell you something. You need to learn to think for yourself. You can see here in the spread, that was a breakdown level from the end of the month. And on the rally back, that's where it wants to go to. It wants to go back to the scene of the crime. Markets always want to go back to the scene of the crime. And then once they start getting above it, like they did yesterday, late day, just kept on going. And that's on a 240-minute chart. So I won't go on anything under an hourly to look at anything. Angel, markets, fundamentals, that it has been in line with the fundamentals. Money for nothing. And the markets have been in rally mode. So it's completely in line with the fundamentals. If you're going to giving away money for free and you can't make money in bonds, it forces everybody into risk assets, which are equities, and they've been doing nothing but going straight up. So they've been totally in lockstep with the macroeconomic regime. Angela, you want to speak to that?
Sure. So, Angel, I wouldn't expect a lot of you students to understand what I'm about to say, but the markets absolutely follow the underlying fundamentals, okay? But you have to have some sort of process or whatever you want to call it in order to analyze what the underlying markets are doing or what the economics are doing at any given moment in time. So I will tell you this, the two most important factors that drive asset prices are the rates of change of growth and the rates of change of inflation. If you can track those two things, you'll be successful. But what I just said is very, very difficult. It's not an easy thing to do. So while it looks like there's lots of debt and inflation is trending, you have to look at it through the lens of, you know, what's the rate of change of economic growth and what's the rate of change of inflation. So whether it be bonds, oil, currencies, copper, bonds, gold, nat gas, oil, okay, any kind of asset class or asset that you can think of is directly affected by those two underlying factors, growth and inflation. It's as simple as that, and that's the way the markets work. Now, the final part of what I'm going to say is that markets are forward-looking. So what happened over the last few days, you know, we've gotten, or the past week, we've gotten a pretty big correction, okay, while simultaneously economic data for the third quarter, okay, which ended on September 30th. Now understand, we are now into October. It's already October 7th. So a lot of economic data for August and September was a little bit on the weak side. And the markets, specifically the bond market and gold, and certain defensive sectors started to sniff that out back in, you know, July, August, in anticipation of that change in the third quarter. Right now, the markets are now beginning to sniff out a different economic regime. What is that economic regime? It's growth accelerating and inflation accelerating. But that's for the US and it's for Europe. That is not for Japan. That is not for South Korea. That is not for China. It is not for Australia. Okay, you kind of got to run this process by country. So what I just said, I'm speaking mostly to the US right now. But the rate of change of growth and inflation is continuing to trend upwards in Europe as well.
So you have trade location and DAX last night on the lows at the 200-day. Japan's lagging. So you can see it in the major indices as you go through them.
You know, if you look at what bonds have done over the past week, okay, they are definitely signaling higher inflation and higher growth. Because bonds don't like accelerating growth. Bonds always go down in that regime. So if you really want to get a sense of what's going on, you have to have all the different markets up on your screens and you have to track them as a signaling mechanism.
All right, so that gets to vision, okay? Now this is how Ira and I have been setting up our screens forever. Here's the Dow, S&Ps, NASDAQ, and that's a pit. So you got daily, weekly, monthly, yearly. Then I start with the currencies, the euro, the yen, pounds, Aussie, Canada, the crosses, euro, yen, Aussie, yen, you know, dollar Swiss, Aussie, Swiss, okay? What I'm trying to do, here's the Italian bonds, the bunds. What I try to do is set up a couple of pages so I can see where you know, what the ETFs are doing, XRT, you know, China's up, materials, home builders, you know, a lot of the different names. you have to be able to see. You can't see what's going on in the world, guys, if you're just looking at an execution screen. There's absolutely no way you'll have any clue on what's going on. And the only other place is to get it from those dumbos on CNBC. So you don't want to do that. And integrated client gives you the ability to set up your screen so you can see what's going on in the world.
Hawachi, to answer your question about the rate of change of inflation crossing a certain threshold, that is what we're waiting to see. But so far, there's no indication of that. Could it happen? Absolutely. Ira and I talk about that all the time. But that line in the sand hasn't happened yet.
Can I ask a question using the microphone?
Speak up a little bit.
Can I ask a question using the microphone?
Sure.
Or, okay, thank you. Good morning, everyone. Angelo, just to pick up on that about the rate of change, how do you actually measure if the current rate of change is positive or negative? Do you put it into historical perspective and try to look at it from there?
Yes. You go back 1 year and you go back 2 years. And sometimes you use an average of the two. Like lately, we're doing an average of the 1 year and the 2 year base effects because of COVID. So the reason we're going back 2 years now is to be able to compare now versus what was happening in 2019 pre-COVID. And what we're seeing is we're actually getting rates of change of growth that are increasing, which means organic growth is actually now a bit higher than what we were seeing in 2019. And, you know, that is now being reflected in the financial markets. Now, what Judd said earlier about money for nothing, money printing, quantitative easing, all of that has an effect. All of that plays a role. So, you know, without quantitative easing here and in Europe and in Japan, would the financial markets be this high? Probably not, but they would certainly be up. Okay.
Thank you.
So yes, so, you know, economic data comes out almost daily. So if you use a Bayesian inference, look up Bayes, he was a statistician. So every time a piece of economic data comes out, you refresh your model to help you, you know, glean, you know, where you might be headed with respect to growth and inflation. But you do not ever make your investment decisions on what your economic model is suggesting, not ever. You first look to the market, you know, like Judd's got his quote board up. Like earlier, a couple minutes ago, I said, you have to be looking at all of the different markets for a confirming signal. So while you have the economic side of your process, you don't act on it unless you start to see signals from the various macro markets confirming or disconfirming your view. If the markets are beginning to confirm your view, you know, then you begin to put on positions, you know, that express, you know, that economic view. So, you know, you can have growth decelerating and you can have inflation accelerating. That's called stagflation. Bonds and gold like that regime. Okay, in the regime of growth accelerating and inflation accelerating, gold and bonds, utilities, and your traditional defensives, those are shorts in that particular regime. You know, another regime is where growth is down, inflation is down. That's where you want to be pretty defensive. So that's gold, it's bonds, it's utilities, it's REITs, and it's cash. And it's being short as well. Okay, so the rates of change of growth and inflation dictate everything. And the macro markets front run all of that. They are, the markets are a discounting mechanism. So that helps.
Yeah, so basically it gets back to, Angelo's got a fundamental model. He keeps updating it and updating it and updating it. I'm only looking at the technicals. I understand the fundamentals because the fundamentals will keep me in a trade, or they'll have me looking to trade a side of the market, whether I want to, I want to be reducing risk or adding risk.
And Judd, yesterday morning, okay, was a perfect example of what you just said. So my economic view had me buying stuff yesterday on the break.
And that chart says it all right there. SPU bonds, 240-minute ORH, morning. In no shape, way, there's no way you fade that. It did it down here. S&P's rallied 100 points. Topped out a little bit up here. S&P's broke 100 points. They bottomed down here. They rallied 160 points. You're getting a heads up on the relationships, when it's going to go risk on, risk off, when they're going to buy equities or when they're going to sell equities. And you can use that to your advantage to either stay out of the way or go with it. Then it becomes a capital flow trade and a time frame trade. So there are a couple of different time frames to trade. This one, there's another hour left in it. Okay, well, they started out the morning relatively positive. The U.S. session opened up at 43.88 with an 86.75 low. When the day started out, I said, just wait a little bit until it settles out to see which way they want to take it. And once it started going up, you don't want to fade that. You don't say, oh, it's going to go to 94, I'm going to sell it. You want to stay with it for the sleigh ride through the capital flow. When money starts coming in, it's going to be all buy or all sell a lot of days. And it'll go, they'll buy for an hour, hour and a half, 2 hours, and then it gets really sloppy and it might sit around all day until the end of the day before you get another capital flow. But that's a big part of who's in, what sessions are live, is the, so this capital flow in the morning was both the US and Europe in at the same time. No, that's S&Ps. This is S&P bonds, Sean. This is what yeah, exactly. This is what you're using for confirmation. So S&P bonds opened up, they gapped higher and they started up. You don't want to fade that capital flow. And as the bonds sold off, they bought equities.
I think China reopens tomorrow or tonight. They've been closed all week.
Well, I see Pindu or whatever that thing is bottomed yesterday. It's up over 5% today. Yeah. Now, this is something you're looking at. This is what Iro is keeping an eye on with Bunge. The grains are soft, but Bunge's been just on a tear. When it opened up this morning, basically at yesterday's highs and wallowed around a little bit, but never really got lower on the day. I mean, it went 3 ticks lower on the day, turned around and came right back up and started up again. I mean, that's a nice chart pattern because then, it's come back, it's cleaned up the chart. There are no gaps. And then, then there's just buying. You can go with something like that. RSX, this is the energy trade.
Hey, Judd, Pete here,
Yeah.
Peter. So for the listening audience, I look at things on a more intermediate term, so I'm looking for setups.
You had a nice one in all the defense names.
Yeah. And, China is very bullish for that sector, so I don't know, I think there could be a lot of good news. But anyway, I'm also looking at, hey, I'm kind of interested in the uranium thing. There's all this shortage of energy, and they're going to have to start building more nukes. So anyway, uranium had a big rally this summer, right?
Oh, yeah.
So now has it consolidated that rally, or is that just rally toast for like months and months? We don't know for sure, but I think the news flow is bullish.
Yeah. And when you look at it off a monthly or, a quarterly, it's kind of right now, it's just basically trading just slightly higher on the quarter. And it's hard to have really good trade location in this, but where it wants to go, if it's good,
Yeah.
it's back to 97.
So for the students, when you see these big long-term moves, I'm interested in trying to capture that. I'd like to be short-term right, but I'm interested in capturing these big moves. So I'm not a day trader at all. Okay. Plus, I believe algorithms own the day trading. It's a very difficult game. There's very few people can make money day trading. So
I just want to put two things in there. They do have a requirement that they have to trade it. They have to make so many trades every day because we want to make sure that they get the feeling of what it's like to trade the markets with the news coming out. They also have access to Dow Jones News, which they can see stories coming in, and News Plus as well from the Wall Street Journal. And but they are required to trade a certain number of contracts every day just to get the experience of trading. One of the reasons, excuse me?
Then they should take profits. If they have small profits, take them.
There you go. The other thing I wanted to point out while we were talking, Judd was talking about currency crosses. I want you to be aware that all of the CME contracts are, except for the Chinese yuan, are calibrated for how many dollars do you get for a foreign currency. Now, sometimes that's opposite the cash number. Now, for example, with euro, they're the same. 1 euro is how many dollars? But I think the Aussie dollar is USD. It comes first. That's going to give you the opposite figure on the futures contract. It's
the same as the futures contract.
Oh, you're right. Where's one where the Japanese yen?
The yen is in inverse.
Yeah, the yen would give you an inverse when you use JY6.
So if it's dollar yen, it has to be going lower this way to be rallying. Here, let me just show you. So there's the future. So if you here, 1 second, I'll give you a cheat sheet to do this here. If you want to take dollar yen, okay, you just on your calculator,
you could actually program it. It's 1 divided by the futures contract.
Right. Or you could, you're just dividing it by 1 and you'll get the futures number in dollar yen. Or you can see it's dollar Mexican and there's a Mexican peso. So as the peso numbers go higher, the peso is actually going lower.
Because they're buying less dollars.
Right. So you can see it here in the Brazilian real. As the real, this is up, 17.68 ticks. The real is down 8 ticks in the futures. It's the inverse.
So just to let you know, because if you're looking at anything that's showing you the crosses and you're going to say, well, why are they so different? They're going to be different on the ones where the dollar is listed first on the crosses, which would be the yen, is the ones that the judge just showed you, except for the Chinese yuan, because the Chinese yuan contract on the CME actually pays in yuans, not in dollars.
All right. So Angel, you're asking about where you open up a position and trade location. That's a big subject. So it's not a short answer as to how do you know when you want to buy or sell. If you want to be long, I've got a model that I've created with price on it and I try to trade at either a major target or a price. Now, yesterday we've gone down. This is basically lines up with 4360 in the S&Ps. So I knew that we were in a trading range between 4360 and 4460. Last night we broke out of the opening. We broke out of the top of the trading range of 4460, and now we've just rallied another 60 points. So you can buy the breakout, which happened last night on the opening. If you look at last night's opening, it's at 43.55 and a quarter. It started up and never backed off. You can trade that capital flow in the Asian time frame.
Change your chart. You got the quote board up.
Oh, okay. So here it is. 43.55 was last night's Globex opening. Okay. So you can see that we were in a 100-point trading range. And one of my last comments before I left was, whichever way it breaks out of the range, you want to go with it. Don't fade it. So there's another 60 points right there. And that gets back into time frame and when it goes. So if we close on our highs tonight, you don't want to be chasing risk. You want to wait for tomorrow. And unemployments are usually pretty straightforward. I mean, all you're doing is following the long end of the curve to see what everything else is going to do. So if the bonds break, gold breaks, silver breaks, dollar goes bid. So the currencies will break a little bit. And then you have to see, how they react. And if the bonds rally, you'll see the opposite reaction. It's generally the indices are, you don't have to do anything in the indices until generally 8:30. You don't miss that much when the New York Stock Exchange opens.
Again, on your integrated client, if you look at your More button, you'll see the Dow Jones calendar. When it comes up to the employment figure tomorrow, if you're on the right date, it will tell you what they call the whisper number. They'll tell you what the market has already discounted. So that's what you're looking at to try to determine whether it's bullish or bearish. And you can get that there.
Thanks, Sean. Let's take a look at that. Good eyes, pal. All right, so here's what I just did, and this is something that you're only going to see this on integrated client, and it gives you a big advantage. This is a pit gap, okay? So this is this chart's US session only. Now, coming up to the bottom of that gap, anywhere up here, you don't want to buy anything coming into this area, because this is the sell before you buy zone until it gets filled and closed above. Now you have this huge, gap down here at 43.81.37 down to 43.55.75. Now look what happens if I go to a mini chart. There's no gap. So you don't see that technical nuance unless you go to a US session chart. And this is something that, and this is one of the big reasons why I like CQG, is because I can see these things in the oil and nat gas, gold, because they still have the US sessions delineated. Here. CLX, that's US. That's the US session right there. Last night they came in at a half of this gap, held and took off. The mini session came down into the averages, held and took off. Now with the market back above 77.47, you have a bullish bias in a bullish short-term bias in the oil. Okay. You look at nat gas. If you look at the pit nat gas, you can see this big gap up where it took off from. All it's done is retest the bottom of where, from the 27th, where it extended from. Hasn't done any real technical damage down in there. So it's just not one thing that you're looking at. It's multiple things that you look at to put together to come up with a game plan for trading. And CQG allows you it gives you the ability to look at different things. Now, let's just go over this other chart. I'll just show you some of the stuff I've got in here so you can see. I've got ETF stocks. Let me just see if I can see if this will come in. Just hang on a second, guys. I want to clear out my temp files for a second. Hold on, I'm going to pause this. Just hang in there. All right, so, I've set up some pattern recognition stuff that lights up if a name's in play. So I'll go into the sectors to see if anything's, showing up. You know, there's nothing really that shows me that there's a major bottom or topping pattern going on in tech. So this is just, you know, one of the capabilities that you have with CQG. I mean, I like to use this stuff just to, you know, tell me what's up. And you can see I use engulfing bull, engulfing bear in all the commodities. You know, there's nothing that's really sticking out. But a big part of trading is you know, getting your heads up. So you need to set up your system so you can see what's going on in the world so that you can get that heads up. See if something's in play, and it gives you the opportunity to get in. You know, not on the day that it's happening, not after the fact. You know, and this is, you know, we like to do a lot of cross asset work. So here's gold and yuan. And that really doesn't tell me much. Gold, platinum,
Oh,
gold, Bitcoin. Actually, gold and Bitcoin, gold's trying to gain on Bitcoin right now. So anytime, anytime anybody in this room looks at an individual commodity, we look at it against other currencies, which, we call demand currencies, whether it's denominated in yuan or grains in Brazilian real. You want to make sure that you're looking at the right instruments. I'm going to give you an example here that I'm going to pull over as soon as this thing builds. Okay, which page am I on, guys?
Pattern recognition.
Okay, here, let's go over here. Here's gold denominated in euros. Okay. Now in the spread bars, it's important to know that if you're looking at a daily spread bar, the interval's got to be set on 5 ticks so you can see it. If you're going to a weekly, then you go to 60 ticks on the spread bar. So you can see where, here it kind of bottomed, gold against the euro, came back, retested, and went. Here you have an ORH gold and euro day, and then it followed through to the upside before rolling over again. But what it does is you look at it for confirmation. Here was a topping pattern when that matched up, I think, last November when we were, I don't know, in the high 1800s in the gold. We had a big, that was a $200 sell-off. But you're looking at all these relationship spreads to confirm the underlying commodity. Just don't look at something at face value. And that's something that CQG allows you to do, which these other platforms don't. You can see these breakdowns and then the retest coming back up. But a lot of times you'll see something in, in gold Swiss, gold in euros, gold in yuan, maybe it's gold copper. That'll give you an indication that it's a real move. Here, gold on the monthly in June 20 had a really strong move. This was off those ECB meetings in July and August, where you had a really big up move in gold. So you're looking to match the contract, the signals, and what's going on in the macro world. ECB meeting, European bond buying. As interest rates went lower, the gold went up. As interest rates go higher, the gold goes down. It's an interest rate sensitive commodity. So you can use CQG to see a lot of these capital flows.
Just to clarify one thing, using futures, that would be, the gold euro would be GCE divided by EU6. That would give you your and you divide it because for that one, because the cash number gives it to you in dollars, but you're starting in dollars. You need the output to be euros, so you're dividing it or multiplying it by 1 divided by the euro. So that would be the symbol, GCE divided by EU6.
All right, guys, any other questions? Stan, you want me to stop the recording for a while? Let guys just look at this and trade, or you want
Yes.
to keep going?
No, that's fine. You can turn off the recording. I was typing that to you in a chat.
Okay. All right, we're going to stop the recording for now, but we're going to do this, in the morning. So you're more than welcome to come in, and you're welcome to stick around for the rest of the day. And you're welcome to come in, every day you get an invitation. And if you want to read the written material, then all you have to do is sign up for a trial, and I'll get you into my distribution system and send it to you. And that's at whitewavetrading.com. And all you have to do is put a name and an email in. That's all that's required.
Thank you, Judd and Ira, if she's listening, and Angelo and everybody else who input. And I hope you found it really helpful for the students from the trading challenge.
A clean link gets sent out every morning.
Do you want me to distribute that every morning?
Yeah, yeah, or I don't think I wanna. Because I shut down the room at the end of the day and clean everything out and start over again. So I
Okay.
usually, I'll send out a link just after 6 tomorrow morning.
Well, I'll have to wait for the CME to send it out to everybody because they have the list, but I can pass it on and we can,
Well, if it's easier for me just to let Zoom run all night, I will. You just
no,
let me
that's not
know.
necessary.
Okay,
I didn't know if we were gonna do it every day or just open it up once a week for updates and things like that.
well, whatever you guys want.
Okay,